Good afternoon, everybody, and welcome to the latest quarterly tax update for professionals from Brown Butler. My name's Craig Hughes. I'm the head of tax here at Brown Butler. I'm delighted that you were able to join us for this presentation. The theme of the presentation today is a budget breakdown. As many of you may be aware, there weren't many significant tax changes announced in the budget, apart from beer duty, which seemed to be the matter that took up most of the Chancellor's speech. Nevertheless, there were some announcements which are worth mentioning, and we'll cover these off in our presentation. And also, we'll then look at some topical tax issues that have fallen out of the budget, but also are things that we're coming across on a regular basis. It's the usual format for the presentation. So we've got 4 speakers today, as always. There's myself, I'll be leading on business taxes. Vicky will then pick up private client matters. James will deal with VAT. And finally, Paul will pick up on the tax dispute and resolution, anti-avoidance, that kind of thing. We'll take questions at the end, if that's okay. But please feel free to send them in as we go along using the Q&A box in the in Zoom. If there are any questions we are unable to answer, then we'll happily pick those up afterwards directly with you. So, without further ado, let's look at corporation tax and business taxes. So, looking at income tax, first of all. Now, as previously announced in September, we've got a 1.25% increase to dividend income and national insurance. This is the health and social care levy. It's called a levy, which obviously means it's not a tax, of course. So from 2022, from April 2022, this is coming into play. It's going to be collected via national insurance contributions for the 22-23 tax year, and then from 23-24, the health and social care levy will have its own platform within HMRC. Remember, it applies to both employees and employers' national insurance, and also to dividend income. It's expected to raise about £12 billion per annum, so it's quite a significant increase. In the budget itself, it was announced that benefit-in-kind rates for cars were going to be frozen in terms of the scale rate, and this is through till 24-25. So what that does mean is that we've got some certainty around the benefit-in-kind position for company cars for the next 3 years. What we're seeing a lot of at the moment is a move to electric cars and having those as company cars. Certainly in recent years, the move has been away from company cars due to the significant benefit-in-kind charges, but that is now turning itself around, particularly when we're looking at pure electric cars, where the benefit-in-kind rate can be as low as 2% per annum. So it becomes very attractive, and particularly if they can be used in conjunction with a salary sacrifice arrangement, for example. For electric cars, they're outside of the optional payment arrangement regime, so we don't get caught by that particular piece of legislation. Another important announcement in the budget was around the basis period reform for unincorporated businesses. So from 6th of April 2024, unincorporated businesses, so sole traders and partnerships, they're going to be taxed on a tax year basis. So an actual basis for the profits arising in the period from the 6th of April through to the following 5th of April. Huge change in terms of how such businesses are going to be taxed, and it will result in a period of a little bit of uncertainty from the client's point of view, but also we have this transitional period where there will be an element of overlap relief, because profits in 23-24 are going to be, in a lot of cases, the profit being taxed will be more than 12 months worth of results. There will be some overlap relief there, and the legislation is providing for the excess tax as such to be payable over a 5-year period. Going forward from 24-25 onwards, we'll then be in a simple tax year basis for taxation. And so the question then arises in terms of, should we just have the accounting period for those businesses as being the tax year? So either 31st of March or 5th of April. The revenue have said that using 31st of March will be deemed to be a 5th of April year end. That would certainly save a lot of trouble in terms of allocating profits from different accounting periods in the future. It's very much a case of watch this space on this. It's only just come out in terms of the draft legislation, and it will no doubt be a topic for future presentations that we do as we find out more in terms of the practicalities, really how this is going to work. Carrying on with the budget, as far as corporation tax is concerned, there was an extension of the tax relief for museums and galleries and theatres and orchestras, clearly two sectors probably hardest hit by the pandemic and the lockdown. The reliefs associated with those sectors gave an enhanced tax deduction, and they've basically been extended. R&D, there's announced a couple of changes for R&D. First of all, from April 23, qualifying costs will be restricted to work undertaken in the UK. That could potentially have quite a significant impact for some businesses. Certainly, I'm aware of software developers in particular who do use a lot of expertise from Eastern Europe in that field. And so this could severely curtail some of those R&D claims. On the positive note, it was announced that cloud computing and data costs will be a qualifying cost for R&D purposes from April 2023. The annual investment allowance has been extended yet again. This temporary allowance, which was brought in on the 1st of January 2019, is now going to be extended through till the 31st of March 2023 at £1 million. That aligns it with the super deduction that's been introduced for companies. Remember, the annual investment allowance applies to both companies and unincorporated businesses. Now, there will be similar transitional rules for periods straddling the 31st of March 23, when the annual investment allowance moves back to £200,000. I suppose one question at the moment is whether it will ever go back to £200,000, given we've had a further extension. We will see. Just moving on from the budget, but something that's very topical and is coming soon is the increase in corporation tax, or the main rate of corporation tax, to 25% from the 1st of April 2023. Now, as a reminder, we're going to have two rates of corporation tax from April 23. We'll have the small companies rate at 19% and the main rate at 25%. The small companies rate applies to profits up to £50,000, the main rate of profits over £250,000. We've then got a marginal rate for profits between those two limits, and the effective rate there is 26.5%. And we're going to get rules reintroduced regarding associated companies. So it's a case of dusting down all those old calculators we used to have in terms of working out what the marginal rate is based upon the number of associated companies. So what does that mean? Well, when we're looking at profit extraction from a company, you'll see here for a higher rate taxpayer, by the time we get to 23-24, and assuming we're a main rate corporation tax payer, you can see there the overall effective rate of extraction is very marginal between a bonus and a dividend. Dividend just very slightly still more efficient, but really there's nothing in it. There's a change in 22-23 as well, when we have the 1.25% NI increase, and that flows through into that as well. And just by way of illustration, for an additional rate taxpayer, again, we have a similar kind of profile in terms of the impact on profit extraction when the main rate of corporation tax goes up to 25%. Again, in 23, 24, very little difference between the two ways of taking profits out of a company. So what does it mean practically then here? Well, we probably need to consider now the number of associated companies. Whilst we've had the main single rate of corporation tax at 19%, it hasn't mattered. But now it will come back to the fore again. And so should we be looking at rationalising companies, merging companies, hiving businesses across in advance of 1st of April 23 to reduce the number of associated companies? There's also a knock-on impact for quarterly instalment payments. Rather subtly and below the radar a little bit, I think, the definition of a large company for quarterly instalment payments is now aligned to the associated companies rules. So at the moment, with quarterly instalment payments, all we look at are groups of companies in terms of determining how many companies we use to divide that 1.5 million of profits. From April 23, that will be looking at associated companies. We need to be looking at what are called, or I've called there, nearly dormant companies. You ignore dormant companies for associated companies purposes. So if you've got some companies that just got a little bit of activity going through there, should we look at just taking those companies, taking that activity away altogether to make those companies properly dormant? With cash-rich companies, you have the right fact pattern here, but there's an argument for disclaiming capital allowances until we get to April 23, when the rate goes up to 25%. And so we're getting tax relief at a higher tax rate. One big question now is, are personal service companies actually worth it? We've got the increase in corporation tax rates, got the off-payroll working rules, which have been in now for a couple of years. We've got the health and social care levy, increasing the rate of profit extraction. Is it actually worth having a personal service company anymore? And then we need to consider alternatives to profit extraction. There's no 1.25% increase on interest on directors' loans or on rent. So should we be looking at how directors and director shareholders extract their money from the company? You have many circumstances where properties, for example, are held outside of a company and maybe rent isn't charged or not charged at a full market rate. Maybe it's time to reconsider that. But particularly as far as properties and rents are concerned, bear in mind the impact that can have from a business asset disposal relief perspective. And finally, on this topic, looking at incorporation. Is incorporation worth it anymore? Certainly when you're looking at purely from a tax angle and profit extraction, with the increase in corporation tax and the health and social care levy, the benefits of incorporating are far less than what they were. They may still be beneficial for basic rate taxpayers, and particularly if, say, you have spouses who are splitting income, it can still work in your favour in those circumstances. And if profits are to be retained in the limited company, then it still might be a viable route. There may also be commercial reasons for using a limited company, for example, limited liability. Although, of course, you could still take advantage of that through a limited liability partnership. With property businesses, again, you need to take into account the restriction on interest. So you only get basic rate tax relief now for unincorporated property businesses. But the way that calculation works could mean that more income is pushed into higher rates. So again, a limited company may be more beneficial there. The bottom line is you just need to do the maths. Every case will be different. There'll be a particular fact pattern, and it is really getting that spreadsheet out, crunching the numbers and seeing what actually works. That's all I wanted to cover off on business taxes and corporation tax. So I'll now hand you over to Vicky to talk through private client matters. Thank you, Vicky.
Thanks, Craig, and good afternoon, everyone. The first slide here is just picking up on some highlights from the autumn budget. So in very general terms, tax rates and allowances are remaining at the levels that we're seeing at the moment in this current tax year. And as Craig mentioned, there's the levy on dividends and national insurance, which are increasing by 1.25% from the 6th of April. So in terms of dividends, it makes the rates of tax 8.75%, 33.75%, and 39.35%. Some of the other announcements connected with the autumn budget are that making tax digital for self-assessment is delayed, so it's now to be introduced from the 6th of April 2024 for sole traders and landlords with income over 10,000, and general partners join from 6th of April 2025. So although they seem a while away, I'm sure they'll be with us before we know it. And a favourable change that's come in is that the time limit for having to submit CGT land returns has been extended. So you've now got 60 days instead of 30 for clients to report and pay capital gains tax due where the completion of the land and property disposal in the UK has happened on or after the 27th of October. So that does give a bit more time, but it's still quite tight and still important to educate clients of that change that came in a few years ago. And there's also some clarification there on the mixed use of properties and the fact that it's only the residential part that goes onto the CGT return. So moving on and away from budget related highlights, now going to look at a key topic that I think will affect many of us, and that's the extension of the scope of the trust register. So many of us will have had to deal with the trust register since the rules came in 2016-17. But the key thing then was that it was trusts that had a tax liability that had to be on there. So on the slide, it mentions the various different taxes. So it was only registrable taxable trusts that had to be on there. And it was always a way to provide anti-money laundering information and keep obligations up to date. So there will still be a number of registrable taxable trusts that we've all got. They need to be kept up to date on the trust register. There's questions on the tax return. And if you don't have a relevant tax liability for a year, then you can do it when the next deadline comes up. But if you need to register for self-assessment, you'd have to be conscious that the deadline is the 5th of October. Otherwise, the ultimate deadline for getting the taxable trusts on the register is 31st of January after the end of the tax year. Now, things are changing. And from now, we need to also be considering trusts that don't have a tax liability, and the scope of the register is increasing dramatically. And these trusts that are caught need to be on the trust register by the 1st of September 2022. So that's only September next year. These are called registrable express trusts, and the trust register is now open to be able to start registering clients that are caught by these rules. So just to move on to the next slide, if you've got trusts caught by the extension of these rules, this basically applies to non-taxable trusts that were in existence on or after the 6th of October 2020. They need to be on the register by the 1st of September next year. And then if you've got new non-taxable trusts created after the 1st of September next year, you'd have 90 days within which to make sure they were entered onto it. And if there's any change in details or circumstances, that needs to be made within 90 days of any changes. So the key changes to be aware of are that all UK Express trusts have to register whether or not they have a tax liability, unless they come under the excluded trust rules, which I'll say a bit more on later. It's likely that trusts which are already on there because they're taxable will have to provide additional information, because again, it's a way of capturing anti-money laundering information, and the regulations are constantly changing. And there is a bullet point there explaining that if you've got non-UK trusts, some of those will be caught, but that's principally where they acquire an interest in land in the UK or enter into a business relationship with a relevant person. Now, penalties may be imposed if these requirements are not met, but it's understood that the revenue will be reasonably lenient on these, at least to start off with. So going into some more detail on the next slide, there are some exclusions which are good, and provided your trust falls within one of these exclusions, and they're not taxable, then you wouldn't have to put them onto the register. So legislative trusts, so they're ones that are caught, by, for example, the intestacy rules or automatic operation of rules. So that would catch personal injury trust, bereaved minors trust, and 18 to 25 trusts don't have to go on there. Trusts imposed by court order don't. Neither do pension scheme trusts. Many trusts of insurance policies don't have to be on there, or charitable trusts. Now, pilot trusts, where the value is £100 or less, and they were in existence before the 6th of October 2020, don't have to be in there. Any trusts created as a result of death, they don't have to be on there for the first 2 years after death, and then you'd need to look if there's any further exclusions after that. Death and life assurance, where that applies, often they don't need to go onto this register. And where you've got co-ownership, trusts of jointly owned property where the trustees and the beneficiaries are identical, they also wouldn't have to go on the trust register whilst they didn't have a tax liability. So that does mean that quite a lot of things aren't caught, but you do have to be very careful at looking what's excluded and checking carefully that you meet the requirements. Given the amount of information that's needed to be collected to get trusts on the register, and the fact that this will catch a number of clients, I do suggest that you start collecting information and notifying clients and contacts who could be impacted as soon as possible. For the trusts that are caught, so they're not within one of the excluded categories, there's no starting time. You go back indefinitely in time, and trusts can be in existence for 125 years now, and the previous time limit was 80 years. So you can see that there could be a considerable amount of trusts out there to capture. Depending on the situation for your trust, you could find that the trust does switch between being on the registrable taxable requirements and the non-taxable requirements. They're both on the same trust register, but there's some differences in the questions you need to answer and the level of detail you need to provide. There is a lot of information to collate, and obtaining the information may not be simple. You need to have information on all potential beneficiaries, so that would include even if they're nominated in the letter of wishes, and family estrangements could impact your ability to get information. There are some new questions on the trust register to do with mental capacity, and really that's there as a signal to the revenue to make it clear that if the person's marked as not having mental capacity, they wouldn't be able to answer any queries if somebody wanted to question anything with them. Now, as you're probably aware from the trust register, if you've used it at the current time, if you part complete an entry, it only stays on there for 30 days before being automatically deleted. So it very much is sensible to gather all the information you need first. And I gather from other training that I've received on this, that if there's anomalies within the information that you're putting, which could be inconsistencies with the information the revenue already holds, that could very much complicate you inputting the information, as the system can tie up different bits of information which it thinks is accurate. So for example, if your national insurance and date of birth records don't tie up, you wouldn't be able to proceed with the application to register it on the trust, and you'd need to liaise with HMRC to get the underlying records corrected, which obviously could take a bit of time. Now, if you had a trust in existence on the 6th of October 2020, when these extended rules are treated as starting to apply, but it was wound up before the 1st of September next year, which is when the trusts need to be entered on the register by, there is some question as to whether you actually need to put that trust on there or not. This is unlikely to catch, many trusts, but I would suggest that if you're in that position, you check the guidance, which is constantly being updated. But at the moment, the recommendation is that you should register it on there and then say it's closed as well, just to make sure that you're meeting the worst case scenario. So there is a lot of information to take on this. This can only be a very high level overview to make sure that you're aware of its extension and to make sure that you're factoring in, contacting people to let them know that they need to consider this and to find out if they want your help in doing it. There is a specific manual on HMRC website that goes into lots of detail on this, and that's the Trust Register Manual. It's got guidance and technical detail on there. And a further update is apparently expected in December, which should cover off some additional points on life assurance policies and joint ownership of assets. Like I've said, there's various different exclusions that can apply. And if your trust falls within those exclusions and it's not taxable, then it wouldn't have to go onto the register. You only need one exclusion to apply to prevent the need to register, but there are a large amount of scenarios caught. And so it's very important to read and apply the exclusions carefully. And please bear in mind that if you have a trust that's taxable, it will always need to go on that register. There are some unexpected circumstances that are caught, and my understanding of the current position is as follows. If you have clients that have junior ISAs for their children or grandchildren, be that cash or shares, then they're understood to be caught by these rules and would need to be entered on here. But if you have a bank account, which is a pure cash bank account with a bank or building society, then it's understood that there's going to be an additional exclusion added to the list, which confirms that bank accounts and building society accounts wouldn't have to go on there, but that junior ISAs would. And this is all to do with anti-money laundering rules and the risk that they could be used for money laundering purposes. Now, bear trusts are also caught, and a lot of us wouldn't consider a bear trust to be an actual trust, unless they're created as a result of intestacy rules, the bereaved minors rules, or the 18 to 25 exclusions. So there's a big category of trust that would be caught as well. Where you've got joint ownership of property, there are some exclusions. And like I said previously, if the trustees and the beneficiary is identical, then they wouldn't need to go on the register. But you would need to register those where the trustees and beneficiaries are not identical. So if you've got minors involved, they definitely need to go on there. And if you've got declarations of trust with more parties than are trustees, they'd always need to go on as well. Investment bonds held in trust would need to be entered. So that would include your discounted gift plans and your gift and loan plans. Some life policies are caught, but it's a bit technical to go into that detail here. Pilot trusts are only excluded if they're created before the 6th of October 2020 and have under £100 in them. So obviously there might be a number of those that would be caught by these rules. And trusts imposed by a court order might be excluded, but a separation agreement done more informally doesn't count. So you have to watch all the precise bits of information that you've got and check all of the details that apply in those exclusions. So in summary, awareness of these rules is likely to be patchy, they are complicated, and it will take some time to see if your clients are affected by this and how many you need to get on the register by the 1st of September next year. It's important to check the rules carefully. All trusts would need to register unless they fall within one of the exclusions in Schedule 3A or Paragraph 6, or it qualifies as a non-UK trust. And I think there's a risk here that with different advisors assisting clients, that everybody could assume that somebody else is going to deal with that. So make sure it's actually broached as a topic and that it doesn't fall between the middle and get missed. For current clients, let them know about the changes as soon as possible. It will take time, and so it's likely to be an area where you could charge an additional fee, but there could be issues to deal with where the trust doesn't actually have any liquid funds, or you might have no ongoing contact with the individuals concerned. And for older files where you might not have had any involvement for a number of years, it would be sensible to establish an internal policy of how you're going to deal with them and how you'll explain to people the approach that you took in advertising, this big change in rules. So I hope that this has been a useful summary to help you, see the extension of this. I know it's something that I've touched on in the past as well, but given some more detail here. And if you need any assistance or have any queries, then do let us know and we'll see if we could help you. But I shall now pass on to James to talk about V80. Thank you.
Thank you, Vicky. Just by way of outline, first of all, on this slide, I will be referencing the autumn budget announcements. As Craig said earlier in his presentation, it was pretty thin this year, but there are also a couple of points that are significant. And I'm looking at environmental taxes, relatively topical after the recent COP26, and there's some changes there underway. And then finishing up with a bit of light relief, looking at the new penalty regime for VAT. So look at the first of these topics, what was in the budget, the autumn budget this year for VAT. it was quite noticeable, I thought, that there were very few announcements, and what was said were, certainly in relation to VAT, was definitely had a very Brexit tinge to it, and specifically in relation to Northern Ireland. And there were two very specific measures. One was about exempting the supply of dental prosthesis when supplied from Great Britain to Northern Ireland, because as we've talked about before, these days when you supply goods from mainland GB to Northern Ireland, you charge VAT because it's all still part of the UK. But Northern Ireland, although still part of the UK, is part of the EU for VAT purposes. So in theory, there should be import VAT when goods arrive in Northern Ireland. That's dealt with by the charge of output VAT from suppliers located in Great Britain. That's all crystal clear, I'm sure. The point is, though, because Northern Ireland has this funny hybrid status for VAT as essentially part of the EU, is that something that was flagged up back in January straight away was a problem with the supply of second-hand motor vehicles from mainly from dealers located in the north of England, who traditionally will supply cars to customers in Northern Ireland and to the second-hand car dealers in Northern Ireland, that actually if you import goods into the EU, second-hand goods, they cannot be subject to the margin scheme. So that meant that second-hand cars going to Northern Ireland from GB couldn't go through the usual second-hand margin scheme, and VAT was due on the full selling price, which obviously then pushed up the price of second-hand cars enormously in Northern Ireland, quite apart from all the recent changes in the second-hand car market generally. And so basically the law has been fudged, and there are now some new rules to deal with that, and so that the second-hand margin scheme can still be used within Northern Ireland. But I think what it does tell us, why is all this significant? It does tell us that there are still a number of teething problems in terms of the UK's relationship with the EU post-Brexit, and all the discussions about Northern Ireland, we know, have been in the news a lot over the last few weeks. It's gone a little bit quiet over the last week, but I think that's going to be a really significant bellwether to understand our ongoing relationship with the EU and how that develops going forward. Moving on to the next part I wanted to talk here was about some environmental aspects, and one of the things that was actually came up in the budget were there were changes to other indirect taxes. Noticeably, there was an announced reduction in air passenger duty, which seemed rather at odds with the whole COP26 vibe recently, in terms of potentially encouraging air travel. It's worth reminding ourselves then about, I was thinking the other week about the 5% reduced rate for suppliers of energy saving materials. So that's designed to encourage people to insulate their homes, in summary. But the recent green space decision of the upper tribunal that came out only last week really served to reinforce how tricky an area of VAT this is. Because you think it seems pretty straightforward to say, well, to encourage people to insulate their homes and take environmental measures and so on, let's have a reduced VAT rate to encourage these behaviours. But in fact, what happened with the in the green space case, which again followed on for some changes a couple of years ago, where new items such as wind turbines, water turbines, you'd think again that seems very green, ought to be encouraged, but due to incompatibility with EU law, they were removed from the list of items eligible for 5% VAT. And then we had the green space appeal, the upper tribunal that came out last week, which shows some of the difficulty in these areas. And green space lost again at the courts. What do green space do? They supply insulation materials for conservatories. So most standard conservatories have a very thin layer of material in the roof. Green space supply a whacking great thick layer of material for the roof that is 95% insulating material. And that's designed to keep heat in the winter and to allow heat to dissipate in the summer. And so why do people buy this, have this green space material fitted in their conservatories? It's to insulate them and reduce their heating bills. That's the whole purpose of it. And yet HMRC said, no, that's subject to 20% VAT, and HMRC have won again at the tribunal on this because of the way that the law is worded, because the law talks about the reduced rate applying to insulation material for roofs. And what HMRC said, well, if you take out this very thin layer of roof and you put this big layer of insulating material in there, that isn't insulation for roofs, that's a new roof. And therefore it's got to be at 20% VAT and not 5% VAT. Now, that seems to be a rather perverse outcome in my view, but you can see, based on what the law says, but it's like, well, the law doesn't really seem fit for purpose is my personal view on this. So will there be changes to the law? Well, you'd think in terms of the green agenda, then there must be a, I was going to use the word climate, but that's probably unintended pun, but there must be the mood must be for changing, I think, the law to make it more attractive for suppliers and consumers to benefit from these reduced rates in order to better insulate their homes. Moving on, another area that's got a bit of highlight during the autumn budget announcements was the new plastic packaging tax. This was first announced nearly 4 years ago, and it's designed to reduce the amount of plastic packaging. And how do we do this? Well, the government does this by taxing it. And so there's been a period of consultation over a few years and recently new draft regulations were published that give a rather more detail on this. What is plastic packaging tax? Well, it's a tax on plastic packaging. More specifically, whether the packaging has got less than 30% recycled content. Now, who needs to register for this tax? Well, it's people who manufacture or import this material. So clearly the idea is that to get everyone to manufacture or import packaging material that has more than 30% recycled plastic within it. And there is a minimum threshold of 10 tonnes. So that means that if you manufacture or import less than 10 tonnes of this qualifying material in a 12-month period, you don't need to register. But above that, then there is a tax currently set at £20 per tonne. And part of the debate at the moment is, well, who will bear the cost of this new tax? Will it just simply be passed on to consumers, or will it actually drive different behaviours and people look to use recycled materials and non-plastic packaging, as clearly the government hopes by doing this? The regulations give a lot more details if you are involved and potentially qualify on things like if you export packaging that you've manufactured, then there is a relief, and so some types of materials have been added in and others have been taken out in the draft materials. So it still hasn't quite all settled down, but certainly by 1st of April next year, it's envisaged that this tax will be in place. And now changing the subject again and looking at, as I said, for a bit of Christmas cheer, let's look ahead to the new V80 penalty regime that's due to come in next April. I attended a presentation from HMRC on this recently, which I think I felt left me with more unanswered questions than before the session. But it's worth flagging, I think. Why is this important? It shows, I think, where HMRC are coming from in a couple of respects. One of them is that they by changing the V80 penalty regime from next year, HMRC are looking to align the V80 penalty regime more with other taxes. And so there's a more consistency across the different taxes by doing this. And secondly, I think it shows a hardening up from HMRC in terms of their attitudes towards late submission of returns and late payment of the tax. And also there's an interesting aspect for me in relation to where HMRC are late in paying repaying tax to the taxpayer. At the moment, we have a default surcharge regime, which says that if you're late with your return and late paying your tax, well, if you're late with your return, you get a free go, first of all, a warning. Then you get charged a surcharge of 2%, rising to 5% the next time you're late, 10%, and 15% with a default surcharge period. So it's based as a surcharge based on a percentage of the net tax due. And if you're late in paying your tax, then at the moment, there's actually no interest charge on that if you're late paying your tax to HMRC. But HMRC do generally encourage people to seek a time to pay arrangement if you can't manage to pay your tax on time. That system is going to be abolished from April 22 onwards, and in its place there'll be first of all a late submission penalty. So this is a points-based system, and basically if you're on quarterly returns and you're late submitting your VAT return, you earn a point, and then once you've clocked up 4 points, you get a penalty of £200. And then there are further points and penalties at that level for subsequent late returns. If you put all your returns in on time for a year and all your VAT returns have been in for the preceding 2 years, you can wipe the slate clean in that. So at first glance, it feels like the actual rate of the penalty doesn't seem too high, really. But then there's also a more complex arrangement in relation to late payment of the tax. And this is where I'm definitely referring to my notes here, because it's sort of a more complicated system with different interest rates depending how late you are. So if after the deadline, if you're paying your tax up to the first 30 days after the deadline, within those 30 days, if you pay in full or arrange time to pay with HMRC, then there's no late payment penalty. If on day 31 you haven't paid your tax in full, then the first penalty is calculated at 2% of the amount that was outstanding at day 15. And then there's another 2% penalty, which is what's outstanding at day 30. If you've still got tax outstanding on day 31 plus, then there's a second penalty that comes in, which is calculated at a daily rate of currently set at 4% APR for the duration of the outstanding balance. So HMRC are definitely looking to get their money in by charging interest on this. It's a more sort of complicated arrangement, but clearly what they're looking to do is for people to pay their tax on time, and if you can't, to sort out a time to pay arrangement with HMRC. Now, there's never any guarantee of getting a time to pay arrangement. It's an extra statutory matter with HMRC. It's at their discretion, but clearly it's worth having a discussion with HMRC if you're in that position. The other point on this about interest is that as well as getting that penalty that's calculated on a percentage basis, there's also a charge for interest. And as I said earlier, currently there's no late payment interest on amounts outstanding from VAT returns. But from the new system from April next year is that there will be interest, which is basically calculated at a rate of 2.5% above the Bank of England base rate. Sorry, I'll just double check that. Yes, yes, that's right. It's 2.5% over base. So the rate would be 2.6% based on current interest rates. And so HMRC, will charge interest there straight away. Just as a final point, the point that really got my attention was, at the moment, if you claim back a repayment from HMRC in your VAT return, then HMRC have 30 days from the due date of the VAT return in order to make the repayment to you. They can stop the clock on those 30 days to spend time on legitimate inquiry, to check out the veracity of your claim. But if they fail to make payment within 30 days, HMRC have to pay you a supplement of 5% on top of your repayment claim. So there's a real incentive for HMRC to deal with these things quickly. That system is going to go, and HMRC will basically will not have that 30-day time limit in order to make the repayment anymore, but HMRC will pay the taxpayer interest on their repayments. And you think, oh, that's great, except that they're going to pay Bank of England base rate less 1%, with a minimum of 0.5% interest rates at the moment. So there's always a minimum of 0.5%, but actually you think, well, that doesn't sound particularly generous. And given HMRC's service levels at the moment are so poor, they're just so slow to deal with anything at the moment, that if you put in a repayment claim and HMRC take a long time to deal with it and give you the money, you're only going to get back base rate less 1%, which doesn't seem, as I said, particularly cheery in the run up to Christmas. HMRC have promised a light touch implementation for the first year, but definitely for anyone who's in that position of submitting VAT returns, they need to make sure that they get everything straight, I think, and before that new penalty regime kicks in. And that concludes my comments this afternoon on VAT.
Good afternoon, everybody. What I would like to do is take you through two topics within the field of tax investigations and inquiries as regards last month's budget changes. And both of these topics, as you will see, give HMRC more powers than they already have. Now, you may think they have quite ample powers, but let's just see what we have. We're going to look at discovery assessments and an extension to how they apply, and also the new powers on tax avoidance. Now, the discovery assessment is something that HMRC have long believed works very much in their favour. Very briefly and broadly, you will all be aware, I'm sure, that after the submission of a tax return, HMRC has 12 months in which to raise an inquiry. That's the normal inquiry window period, and that's well understood. In addition, however, there is a piece of legislation which, if you care to look at it, is section 29 of the Taxes Management Act of 1970, which is entitled Assessment Where Loss of Tax Discovered. And it's all about the word discovered. What HMRC are looking at here is, were they in receipt of insufficient or inadequate information, or maybe no information on a particular matter that would thereby have prevented them from inquiring in the normal 12-month inquiry window. So the period in which they can inquire and basically raise an assessment is extended from up to 4 years, 6 years, or worst case, 20 years. So you can see why HMRC favour discovery assessments, and they apply this quite heavy-handedly at times. Now, in the last 20 years or so, the cases that have gone to a tribunal to test whether HMRC are able to raise a discovery assessment in a particular case have tended to go their way. except there was one case earlier this year, which was a gentleman called Jason Wilkes, who went to the upper tier tribunal and was able to argue that actually this piece of legislation didn't apply in his case. Now, his case related to the high income child benefit charge, which, as most of you will know in handling clients' affairs, is a particularly difficult issue to be absolutely clear that the client understands, firstly, that they could be caught by it, and also to let you know that it therefore needs to go on the tax return, and it's therefore easily overlooked. HMRC didn't like the outcome in the upper tier tribunal as regards this decision. So what they have sought to do, and it will come in the forthcoming finance bill, is with retroactive effect to basically say, well, HMRC has always had that power. It doesn't matter what the upper tier tribunal's decision has been. It will also apply to cases of gift aid and a number of pension payment charges as regards income tax. You won't tend to see many of those, but this is where this extension will apply. There is a little bit of assistance as regards the Wilkes decision, which is being contested by HMRC, is that if a client, alongside the circumstances of the Wilkes case in the upper tier tribunal, has very similar circumstances, then that client will not be affected by that decision that will now be brought in retroactively. However, HMRC are appealing the Wilkes case to the Court of Appeal anyway. So what they're basically saying is, well, we don't like the upper tier tribunal decision, we think it's wrong. We will bring in retroactive legislation, and by the way, we're going to pursue it to the Court of Appeal. And if they lose in the Court of Appeal, it's quite possible they will take it to the Supreme Court. So the point here for practitioners is, if you look at the way HMRC are handling these types of cases, they don't seem bothered that there is a piece of legislation, which is section 28H of that same Taxes Management Act, that enables them to raise an assessment in certain circumstances. But I've never seen one of those cases, and they seem to readily recognise that it's more trouble than it's worth, actually. They'll just go the discovery assessment route. We will therefore see in the forthcoming finance bill that HMRC will use discovery assessments in circumstances where they believe that there is insufficient income tax or capital gains tax which has not yet been assessed, despite being, in their view, due. And the view of the profession seems to be that, well, it's turning these type of assessments into, if you like, what's known as now an anything assessment by HMRC, which is always what they've wanted it to be. The point for practitioners here, though, is be very mindful about making sure that the client's return does show a full disclosure. And the reason plainly for that is to prevent HMRC being able to argue discovery. Remember that HMRC have to be able to demonstrate discovery. It isn't sufficient for them to say, well, in their opinion, there may be something that hasn't been returned or inadequately assessed, or in their view, or perhaps there will be, or they suspect that there will be. Those arguments are not adequate, and they need to be addressed accordingly. And to put HMRC basically on the spot by saying, demonstrate why you, HMRC, think you have made a discovery, and it puts them on the back foot. They don't think they will need to do that, but they do. And as practitioners, we need to be very mindful of that. The second topic I want to go through with you is the clampdown on tax scheme promoters. The climate now for tax schemes is very different to how it was in the heyday, so to speak, of tax avoidance schemes, probably 10 or 20 years or so ago. Both as regards the tide of public opinion, but also how the legislation has come in over the years, making it more and more difficult for tax schemes to be successful in the cold light of day. And also cases in the tribunals and in the courts. The most infamous, I guess, of those is the Glasgow Rangers Football Club case regarding employee benefit trusts, whereby HMRC were determined to pursue that case right the way through the judicial process. They had lost at every level through what was the commissioners, through to the High Court, to the Court of Appeal, but they took it to what was the House of Lords for these cases at that point, and they were successful in that case, and it very much emboldened them as to how they would then go after tax schemes. But one of the things that bothered them and bugged HMRC was that they couldn't quite nail the promoters of these schemes. They had plenty of legislation and tax cases to argue individual cases as regards the taxpayer. But what about the promoters of these schemes themselves? And this is what this particular topic is about. And what they're seeking to do is to basically take the promoters out of the market as regards the promotion of mass marketed avoidance schemes. So let's see what the 4 measures are. The first one is to do with freezing orders. Currently, HMRC can only apply for a freezing order on a company's assets once what's known as an existing cause of action has happened, broadly an enforceable debt, which in the time frame of these things is probably, from HMRC's perspective, going to be too late for them to do what they would like to do, which is to pursue the value. So what they're going to look for here is provisions for a freezing order to be made at the same time as an initial application to the tribunal for a disclosure of tax avoidance scheme penalty, basically, to bring it further forward in the time process. The second element of this is offshore promoters themselves, and the additional powers that they are going to bring in is to be able to issue a penalty of up to 100% of the proceeds levelled against the UK entities that are fronting or facilitating these schemes on behalf of the non-resident promoter. A lot of these promoters that HMRC haven't been able to really nail yet typically have been in the Isle of Man or the Channel Islands, for example. And it's how do HMRC pursue those promoters? So what they're now doing is saying, well, there are a number of UK entities that will front or facilitate these schemes that are being promoted from these offshore havens. So what they will look to do is make life more difficult for the UK entities. And there is a monetary threshold which is relatively high in the types of cases we may see, but nonetheless, it will make life more difficult. It does only apply where the existing disclosure of tax avoidance scheme or the promoter of tax avoidance scheme penalties exceed £100,000. The third item is where they would like to consider the winding up of a company or a partnership that is operating against the public interest, as they put it, by operating tax avoidance schemes, although they recognise that the final decision on the winding up of the organisation will remain with the court, but nonetheless they will be making steps and putting pressure on to apply winding up procedures far more readily than otherwise they would have. And the final item in this group of 4 is more on naming and shaming. What HMRC are going to do now is to publish information about the schemes and their promoters much more quickly than has previously been the case. They will only now have to give 30 days notice to the promoters. And the point of this is to alter the thinking of the potential user of a tax avoidance scheme, basically by making it so difficult that somebody who is contemplating going into a scheme is basically going to have to think long and hard before they do because of the ramifications and the consequences of so doing. And the point for practitioners here is if there are any clients or prospective clients that are still minded to undertake a tax avoidance scheme, they would be well advised not to do so for all these types of reasons. And there we are, right on time.
Thank you, Paul, and thank you too to Vicky and James for your presentations as well. Very illuminating as always. We do have a couple of questions in, which I'll just slot in before. I appreciate it's nearly three o'clock. Just to let you know, first of all, that the webinar is being recorded. So if you do want to go back and have a look at it, then it will be a link to it will be on our website very shortly. We don't distribute the slides themselves, but please feel free to go back and look on the website for the link and watch it again if you so wish. So we'll just do a couple of questions. First one is for myself on the health and social care levy. How does this impact those above state pension age? Yeah, so this is all around the fact that the way the levy is being introduced is that for the 22-23 tax year, it's linked to NI, and for 23-24, it's going to have its own system. So in 22-23, because it's simply going to be linked to national insurance, anybody above the state pension age doesn't pay national insurance, and so they won't be impacted by it until 23-24, and that's when the health and social care levy will have its own system at HMRC. There'll be a separate line on the payslip, and that will then capture those working above state pension age. And one for you, Vicky, we'll just do this one. The Trust Registration Service talks about express trusts. Could you just briefly explain what an express trust is?
Oh yeah, thank you, Craig. Yes, I think on the slides it does mention express trusts as well. So they're trusts that are actually created deliberately by the settlor. So that would often be, or usually be, through a written trust deed or a declaration of trust, and they can apply both in lifetime and on death. So they're different to trusts that come into being through the operation of the law, such as the intestacy rules. So that's why trusts that are created deliberately by a settlor are caught, but the ones that are created automatically by law aren't. So the Trust Register Manual has lots of information. So that's the TRSM if you want to find out further details.
Right, thank you. I'm conscious that we've gone past 3 o'clock now. So again, thank you all to the presenters for presenting, and also for the participants for logging in and joining us. We look forward to catching up with you again in 3 months or so time, hopefully around February time, although I guess there's probably going to be a budget in March, so we may defer it until after then just to capture that, but let's see where we are then. Now it's the 30th of November. I don't think it's too soon to wish you all a good Christmas. We're nearly in December. So please, everyone, have a good, safe Christmas. And we hope to see you all again soon. Thank you.